Well, welcome everybody to the Edmund Clark Distinguished Lecture on Public Policy, which was made possible through the generous donation of the Clark family in recognition of Ed Clark's interest and contribution to public policy. This lecture series is shared by the Department of Economics and the School of Policy Studies on an alternating basis. Now, probably not many of you know who Ed Clark is, with one notable exception, his nephew here. Let me say a few words about Ed Clark before we start. He was actually a graduate of the University of Toronto who completed his PhD in economics in Harvard in 1974. There's a reason for mentioning this I'll get to in a moment. He was a federal civil servant from 1974 to 1984, where he was largely responsible, among other things, for the National Energy Program that was put forward by the government of Pierre Elliott Trudeau. And his work in the civil service won him the Outstanding Civil Service of the Year award. This was a federal award, not an Alberta award, I should say. He went to the financial sector and rose to be the CEO of Toronto-Dominion Bank, and was responsible for nurturing something called TD Economics, which you may know was the bank's very respectable think tank. Since his retirement from the Toronto-Dominion Bank, he's served as the chair and co-founder of the Vector Institute on Artificial Intelligence. He is a board member of the Brookings Institute in Washington, and he's most recently been an advisor to the Ontario Premier Kathleen Wynne. Now, to segue to today's lecture, the first Clark lecturer was the Canadian Nobel Prize winner in economics, Michael Spence, who was Ed Clark's classmate at Harvard. And he gave a very nice lecture on the policy implications of signaling, as you might expect. Coincidentally, the year that Clark left Harvard was the year that Alan Auerbach arrived, so they never really crossed paths. So let me introduce Alan to you. He is a very distinguished public economics scholar who's the Robert D. Birch Professor of Economics and Law at the University of California in Berkeley. He's previously taught at Harvard and University of Pennsylvania and has had many honors and accomplishments, including, to name a few, editor of the Journal of Economic Perspectives, the founding editor of American Economic Journal, Economic Policy, vice president of the American Economics Association, president of the National Tax Association, and a fellow of the American Academy of Arts and Sciences and of the Econometric Society, to name a few. Alan is a public economics specialist, but his contributions have been very diverse within the field. His work spans public microeconomic theory, both positive and normative, empirical public economics, and fiscal policy. He has made fundamental contributions in capital income taxation, corporate taxation, taxation and investment, and dynamic policy analysis. He co-founded the concept of generational accounting, which is used worldwide, including in Canada. And he was one of the first to analyze dynamic fiscal policy in an overlapping generations model with heterogeneous households. In addition to his purely scholarly work, he has done much work of what I would call an educational synthesis type that's been of great value to the profession, such as co-editing the 5 volumes of the influential Handbook of Public Economics, to which he also contributed a chapter. He's also done much policy work and provided much policy and public advice. The latest example is his work on the so-called destination cash flow corporate tax, which, if you haven't heard of it, formed the basis for recent corporate tax reform proposals in the US, some of which were recently enacted, not all of which. No doubt he'll have a little bit more to say in his talk today about this. So I leave it to Alan to talk about tax reform in the 21st century. Please welcome Ellen Auerbach.
Thank you, Robin. It's a pleasure. Thank you, Robin, for your introduction. It's a pleasure to be back at Queen's. I was trying to remember earlier how long it's been, but it has been quite a while, and I do remember fondly my past visits to Queen's, and it's although I guess I'm remembering visits at a somewhat different time of year, but in any event, it is a pleasure to be back. I'm talking about tax reform in the 21st century. And the idea here is that times are different now than they have been in the past. And so we face different challenges in thinking about tax reform now than we did in the past. And I'm speaking both from a perspective of sort of worldwide developments, but obviously coming from the US and thinking about particular problems we have in the US. Many of the problems we have in the US are problems that you share in Canada and other developed countries, and I will be talking about international comparisons. Some of my data come from the United States alone, where in certain respects we have some problems that are more extreme, others that are less serious than in other countries. But I don't want you to think that I'm sort of equating the US and the world. Notwithstanding any nationalistic noises you might have heard from south of the border in recent months. The basic setting in terms of thinking about tax reform in the 21st century is to think about two economic challenges that many developed countries face. The first one is increasing inequality, about which much has been written. One of the things I should say, as something of a caveat, I'm not going to say much more about it as I go along, but it is important to think about the inequality being within countries as opposed to across countries. That is, if you were to look at worldwide inequality and think about standards of living for the population on the globe, things have actually gotten better in the last few decades, not worse, in large part because of rapid growth in incomes in large countries like China and India. They're doing much better than they were doing a few decades ago, and there are a lot of people who live there. And so if we think about inequality, the very rapid development in many less developed economies has really reduced worldwide inequality quite a bit. Brought people above the enormous gains in terms of bringing people above the poverty line. That development notwithstanding, there are significant political and social problems associated with increasing inequality within countries or within the developed world as a whole. And that's what I'm thinking about when I say increasing inequality. The second is increasing fiscal pressure. That is, we think of governments as having function of raising taxes and spending money, and to some extent there's a constraint that says those things need to be roughly equal over some period of time, and we are not really in a situation like that, and we're moving away from that. And as a result, where governments are facing fiscal pressure. We've had financial crises in particular countries in recent years, Greece, for example. But the problem is far bigger than the problem of Greece. And it affects pretty much most of the developed world, even countries that may not recognize politically that they have such a problem. And it means that we need to address our tax system as well as the way we spend money to do something about it. So these are the problems that we're facing, both of which call for some sort of modifications in the tax system. You might say, in dealing with increasing inequality by trying to make the tax system more progressive, dealing with increased fiscal pressure, perhaps by raising more revenues or having reforms of the way we spend money. So I'm going to talk at the end about potential solutions. But let me talk about the nature of increasing inequality. There are many different ways that this increase in inequality is commonly expressed. Perhaps the most common, certainly in the United States, but I think in other countries as well, has been by talking about the 1%, the top 1%. So here is some recent estimates, which I've drawn from the World Wealth and Income Database, which is a collection of data originally put together by a few economists, including the British economist, the late Tony Atkinson, Thomas Piketty of Paris, my colleague Emmanuel Saez are probably the three who've made the biggest contributions there. Basically collecting data on the market incomes of people in different countries. And it covers many more countries than I can show you here. It's pretty hard to put such a large number on the graph. So in this and in subsequent graphs, I'm going to be focusing on the G7 countries, which conveniently includes both the United States and Canada. Top 1% income share of total income actually is not such an easy thing to calculate because there are a lot of questions one has to address in terms of measuring what to include in measurements of income. It doesn't matter for the broad conclusion that inequality has been increasing. And this is reflects the various choices, methodological choices that the people who put this website together have made in coming up with measures of market income. The incomes that people get not from the government through taxes and transfers, but basically just their market incomes, how much income from labor, how much income from capital, add it all together and take the top 1% of the population, and this is what you get. And the two things that are perhaps most notable about this are first, that the United States, which is in yellow there, is far and away the country among the G7 with the greatest inequality as measured by the share of income going to the top 1%. This goes back to 1984. These are very high quality data, and one doesn't have that kind of data for very many countries going back much earlier. If you did go back for the United States, as people have done, you would find it not just continually upward sloping, but rather U-shaped. That is that the US had a period of extreme inequality around the turn of the 20th century, the so-called Gilded Age in the United States, when people like John D. Rockefeller walked the earth and ran large companies. It then fell during the two world wars and the Great Depression. Then it was stable for a period around the 1950s and 60s. And then it started rising. And it's been rising pretty much ever since. Of course, you see ups and downs, but it's not, the trend is unmistakable. That's the first thing to note. The second thing to note is that it's true for pretty much every country. Certainly over shorter periods of time, you see the share going down, but for this group of countries as a whole, you see the share of income going to the top 1% rising. So even though we in the United States often talk about the United States as having a particular problem in this area, which we do, this is not something that is just happening in the United States. It's happening throughout the developed world, and as I said, it's happening in the context of inequality getting less severe on a worldwide basis, but nevertheless, within countries is something that people are paying a lot of attention to. I mentioned Canada, the United States. Canada, lower, in recent years, there, at least the last few years of data, dropping down, but still increasing over time. And it's worth thinking about what this means. If for the United States, it's saying that in recent years, a fifth of all income went to 1% of the population. That's a pretty big degree of inequality. Another way of expressing it that doesn't just look at the top 1% is to look at income growth in different groups of the population. And of course, the answer is not going to be inconsistent with what I just showed you, particularly when you look at the top 1%, but it also tells you more about what's going on elsewhere. So this is for the United States. Data come from the Congressional Budget Office, showing not the shares of income, but the growth rate of income starting from 1979, the cumulative growth rate of income. And obviously, if the income of the top 1% is increasing as a share of the population, that means their income has been growing faster than the rest of the population. And you can see that here. Cumulative growth of the top 1%, way above the other groups in the population. The top quintile, except for the 1%, the yellow line, the middle 3 quintiles, the middle 60%, the green line, and the bottom 20%, the red line. One of the things you can see about this is, first of all, that it is very cyclical. One of the reasons why the top 1% has numbers that bounce around so much is that in recessions, their income goes down a lot more. They have a lot of wealth, a lot of money in the stock market. When the stock market goes down in recessions, they suffer big income losses relative to other groups in the population, but then, of course, it rebounds when the economy does well. The other thing to point out here is that it's not a monotonic relationship. That is, the better higher up you are in the income distribution, the better you're doing. The middle 60% have not been doing better than the lowest 20%. So this is very much a phenomenon of the top, and to some extent, the very top, and to some extent, those a little, the top 20%, the people in yellow. Everybody else in the population has pretty much had very, very low income growth. It's not negative if you go throughout the entire period, but it's quite low. And a lot has been written about the factors that have been leading to that, in particular why those in the middle haven't been doing so well, having to do with such things as technological change, globalization, trade, and so forth. Now this is to begin to talk about the government, this is what's happened to income after taxes as well as transfer payments. That is, there are different ways one can measure income. This is what we might call disposable income. After you get public pension payments, public payments for health care, after you pay taxes to the government, this is what you're left with. And in the United States, the general picture is not that different, though top 1% are still up there even after they've paid their taxes. But if you compare them, just look at these two different figures together, one of the things you'll see is that by the end of the period, the top 1% are pretty much where they are in both cases. Their growth in after-tax income and their growth in before-tax income is around just under 200%, whereas for the other groups, especially the bottom 4 quintiles, the red and the green lines, growth rate is much higher as you look at the after-tax rather than the before-tax income. Another way of putting it is government has by no means made the increase in inequality go away, but it has mitigated it to some extent. That is, it's still there, but it's not being caused by the government. The problem of inequality is not being caused by the government. It certainly isn't being exacerbated by the government in terms of its tax and transfer policy. Some people will sometimes loosely say, well, the government is giving all the money to the rich. This is something one hears in the US. It could be that one is arguing that they're giving, the rich aren't paying enough, but it's which might or might not be true, but it is certainly not true that the tax system is regressive in any way. The fiscal system as a whole is helping those at the bottom more than it's helping those at the top. Another way of putting this is to look at the overall inequality, not just looking at the 1%, but using the Gini coefficient, which is an overall measure of inequality. The higher it is, the more income is concentrated among a smaller number of people at the top of the income distribution. The Gini coefficient in yellow is the before-tax income, the before government involvement in the calculation, and it shows the Gini coefficient going up over time, inequality going up. Inequality has been going up for the red line, which is after taking account of transfer payments the government makes to households. and also taking account of transfers as well as taxes that the government collects from households. Two things to note here. The most important thing is that the general trend is present in all of the graphs. The second is that government policy does make, in general, make the distribution of income less unequal. The green line lies everywhere below the red line, which lies everywhere below the yellow line. And the final thing is, and you have to squint a little bit more to get this, the green line hasn't risen as quickly as the yellow line. That is, over time, as inequality has worsened, the government has mitigated, not only mitigated overall inequality, but mitigated the growth rate in inequality in the country. Now, all that said, I want to issue a couple of caveats about our measuring of inequality. In some ways, we're failing to take account of things that make the picture worse. But in other ways, we may be not paying attention to things that make the picture not quite as bad. So I'm not saying that overall the inequality problem is less severe than I've characterized it, more that we need to take a more comprehensive view to get a full picture. The first has to do with things that actually make it worse, which is life expectancy. For a long time, economists and demographers have known that there's a positive correlation between things like income and education and life expectancy. Higher income people, more educated people tend to live longer than people who are less educated and have lower incomes. And there are various complicated sort of just channels through which this happens. In some sense, both ways. If you're a higher income person, you may, or more education, you may understand better about taking care of yourself. You may seek medical care more effectively. On the other hand, it's also true that if you're sick, you're less likely to earn high income, and so you'll show up as somebody who has lower income, but the causality in that case is going in the opposite direction. In any event, one of the interesting things that's been happening, and this is from a study that I did with many co-authors as part of a panel for the National Academy of Sciences in the US recently, we were looking at the implications of differential mortality for government programs. But in the process of doing that, we came up with some projections for life expectancy at age 50 for different birth cohorts of males. We did it for females as well. I'm focusing on the males only because our calculations were, we thought, more robust. There were some issues with the calculations for females. And what we found is that if you look at birth cohorts in 1930, for which we have, to a large extent, full information on what life expectancy was, as well as those for 1960, where we're projecting forward for many people who are still alive, but with pretty good predictors based on what's happened in the past. We can see that if you divide the population into 5 income quintiles, there's basically no growth in life expectancy for the bottom 2 quintiles. And virtually all of the growth is at the top, basically in the top 2 quintiles. That is, not only is life expectancy higher for the higher quintiles, the red, even the older, that's true for even the older cohorts, but it's become much more true. And I should add that this is separate from another very striking development that's been observed in the US in the last couple of years, which is the effect of the opioid epidemic on life expectancy. That is pointing in the same direction. Less educated, lower income people suffering from declining health and increasing mortality. The reason why it's separate is it's really for a different age group. This is looking from age 50 onward. Most people who suffer from opioid problems by the time of age 50 are not, if they're going to die, they're probably dead already. And as a result, we're not looking at the same population. But that certainly would compound what I'm showing you here. That is, if we were looking not from age 50, but looking, say, from age 18, then we would probably see an even starker variation between high income and low income population groups in terms of changing life expectancy, which certainly suggests that the issue of inequality is more serious once one goes beyond after-tax income measures. On the other hand, we tend to look at, when we look at the kind of income measures I showed you, we tend to look at snapshots, that is, people's income at a particular point in time. Now, if you're looking at people who are all about the same age, that's okay. But if you're looking at people who are very different ages, that can lead to confusion. For example, if you're comparing a 40-year-old in the middle of working life to a 70-year-old who's retired, you might say, well, the 70-year-old isn't earning much income. 70-year-old's getting a lot of money from the government, and therefore the government's fiscal system is very progressive, because here's a 40-year-old earning a lot and paying taxes. Here's a 70-year-old not earning much and getting a lot of money from the government. But on a lifetime basis, that 70-year-old might have been as well off or better off than the 40-year-old. And so seeing that that 70-year-old is getting money from the government shouldn't make us feel good about the government's action with respect to income inequality. It could even be, as there is much concern in the US now because of low productivity growth rates, that generations that are 40 years old now may not do as well as generations that are 70 years old on a lifetime basis. And if that's true, then taking money from 40-year-olds and giving it to 70-year-olds may not really represent a progressive policy at all. So what one might want to do to respond to that is to look at things more on a lifetime basis. And this is from a paper that I've done recently with my colleague Larry Kotlikoff and Daryl Kohler, where we've done projections where we didn't have data, trying to look at lifetime resources going forward for particular age cohorts, not just the current year, but for all years in the future, taking account of the wealth they've already accumulated as well as the income we project them earning in the future, and taking account of life expectancy. And we said, how does it, if we look at the share of lifetime resources for the population as a whole, how does it compare to what we would measure if we just looked at current income? The current income being what I was already showing you. Well, if you look at market incomes, there isn't that big a difference. In fact, there's probably just a little bit more inequality if you look at a lifetime basis than if you look at current income, at least for people who are between ages 40 and 49. That is, taking account of the wealth that they have, all the income they're going to earn in the future, actually makes the issue of market income inequality look a little bit worse. On the other hand, if we look at the role that the government plays, it turns out, and this is sort of contrary to the example I gave you with the 70-year-old pensioner and the 40-year-old paying taxes, it turns out that if you look on a lifetime basis, the US fiscal system, and this is for the US, is actually slightly more progressive, somewhat more progressive, especially at the bottom, more than slightly, than our annual calculations show. This is showing the tax rates, that is the share of the ratio of taxes minus transfer payments received. So it's negative. It means the household has received more transfer payments than paid taxes on a lifetime basis and on an annual basis. So on an annual basis, the people in the bottom quintile get money back from the government. That is, they get more than they pay through various low-income support programs. But it's an even bigger share if you look on a lifetime basis. And that is the reason why the green bars are lower than the red bars throughout, is because for people who are in their 40s, they're still working, they still are younger than the age when they're going to get the biggest benefits from the government through the form of old age pensions and very intensive health care spending. And when one takes those into account, it lowers the tax rates on a lifetime basis that everyone's going to pay, but it actually lowers it especially for the people toward the bottom. So this suggests that perhaps underlying inequality is no better, but perhaps the government is doing more than one would suggest by looking at annual calculations. So that gives you a sort of picture of inequality, perhaps measured more broadly than we're accustomed to doing, but nevertheless confirming the view that we have a problem of inequality that is getting worse. The other problem that's getting worse is fiscal pressure, and I'll define more what that means as I go along. So perhaps the most familiar measure that we use is government debt. And this is measures of government debt taken from, it appeared in a paper I wrote with my colleague Yuri Gorodnichenko in the fall. We did the calculations from data from the IMF database, the most recent version at the time the paper was written. This is net general government debt for governments at all levels, where governments at lower than national levels also issue debt for the G7 countries for 2 years, the end of 2007 and 2016. And we chose 2007 because that was the last full year before the global financial crisis. So that was sort of where we were when everything started to go downhill, and where we were most recently. And as you can see, with the exception of Germany, every country's debt rose as a share of GDP. In some cases, not very much for Canada, quite a lot for the other countries except for Canada and Germany. The United States went from having a relatively low level of national debt to having a national debt. This is publicly held national debt, over 80%. Sometimes calculations of national debt, in case you see other numbers that look different from this, are gross government debt, which includes debt held within government agencies. So for example, in the US, our old age pension social security system holds several $1 trillion of government debt issued by the US government. It seems kind of, for most purposes, not sensible to include that because it's held within the government. And so these calculations net that out. These numbers have risen. And so if we were thinking of a single measure of the fiscal situation of a government, we'd look at this and we'd say, gee, not only has debt risen in these countries quite a lot, in most of them, but it's now quite high. In Japan and Italy, well over 100%. Well over 1 year's GDP would be needed to pay off the debt. Now, as with inequality, one wants to think about demographics in order to get, and it's just really important here, to get a sense of fiscal pressure. Because it's not just the government debt. And this is where even countries that may appear to be in reasonably good fiscal shape need to have concern. But rising old age dependency ratios. So here are US Census projections, Census Bureau projections for the G7 countries for basically now in the red versus projections for 2050. Old age dependency ratio, basically the ratios of population 65 and over to the rest of the population. And you can see it's increasing everywhere. Societies are getting older as a result of two factors: declining birth rates and increasing life expectancy. And it's quite big in some countries. Japan, notably, which is already the oldest, is going to become older by an even greater measure by 2050. Low birth rate, very high life expectancy. The United States is somewhat smaller than others because of, among other things, somewhat higher birth rates and somewhat higher rates of immigration. Now, how does the old age dependency ratio figure into measuring fiscal pressure? Well, it has to do with thinking about the spending that we're going to have to do as the population gets older, because all of these countries have social insurance programs which are age-based and spend a lot of money on the elderly. And so in order to incorporate that, because we're really talking about something that's going to happen in the future, we know we're going to have to spend more on the elderly as there are more and more elderly, but it's not in our current measures of deficits, it's not in our current measures of national debt, but we know we've got a problem. Well, how do we deal with that? Well, there's Robin mentioned generational accounting. There's a somewhat, it's related, but a somewhat simpler approach is just to ask not how will the burden fall if we don't make adjustments, which is what generational accounting does, but just to ask rather, how big would the adjustment have to be for us to keep national debt from increasing to an unsustainable level? So in particular, ask what share of GDP on a consistent basis would we have to reduce primary deficits, that is, leaving interest aside, cutting spending or increasing taxes, by what share of GDP would be necessary annually to hit some target debt to GDP ratio, typically the one where we currently are, or maybe even a more sustainable one, at the end of some projection period. Now you can think of this calculation as involving three components. The first is deficits that we've run in the past. That's the national debt. By definition, the change in the national debt from one year to the next is the deficit that a country runs. That's how we define the deficit. It's a change in the debt. And so if you look at the accumulation of deficits over time, that's where we are now. So you could think of the national debt as a legacy of our past fiscal policies. It's telling us where we are now in terms of what we owe. It has nothing to do with what we're going to do in the future, but it's saying what obligation we already have as a result of our past actions. And dealing with the national debt from a point of view of the fiscal gap, national debt makes the fiscal gap bigger because we have to service that debt. We've got to pay interest on the debt we've already accumulated. And if we want to reduce the debt to GDP ratio, that's going to take resources as well. And so that's one component of the fiscal gap. The second is our current deficits, because we're making the problem worse. If our deficits are sufficiently big, then we're going to increase the debt to GDP ratio. So not only will we have to deal with the debt that we've already accumulated, but we'll have to also deal with the deficits we're currently running. And most of these countries currently are running deficits. And then finally, and this is where demography comes in, there are future deficits, by which I mean not just the fact that we'll continue to run deficits in the future, but that those deficits perhaps may be larger because of changing population structure. That is, if the US, because that's the country I know best, if the US were going to keep its current fiscal policy exactly as it is, not make its public pension system any more generous, not change its system for healthcare provision, government spending would grow very rapidly over the next few decades as a share of GDP. And the reason for that is that our old age population would be rising as a share of the population. And so the programs that cost money based on expenditures to the elderly would become bigger relative to the economy. And so in that sense, the future deficits will be larger because we have a larger old age population, and in addition, because healthcare spending per capita, even controlling for population size, is growing. It's growing in the US, it's growing pretty much everywhere. It's a little bit like inequality. There's a general trend upward in healthcare spending per individual, even controlling for the individual's age. Now, as an example of why you want to marry these different components together, consider the US in 1946 and the US now. The highest debt to GDP ratio the US ever had was in 1946. That was the end of World War II, the year after World War II ended. We'd spent several years running very large deficits to fund the war. We raised taxes too, but most of the money came from borrowing. And so the debt to GDP ratio went from a very low number to a very high number. And yet we didn't really perceive our country as having a big fiscal problem in 1946. Because going forward, we didn't face the kind of pressures that we face today. We had a very young population, a very high birth rate. We had very, very modest social insurance programs. And so we didn't have that kind of future spending. We weren't running deficits at the present, and we didn't have that kind of future spending explosion to worry about. And indeed, the debt to GDP ratio came down quite rapidly after the war. 2017, our debt to GDP ratio was lower. And so you might have looked at that and said, well, gee, things were not as serious in 2017 as they were in 1946. And yet it's very much to the contrary, because we were running pretty large deficits in 2017. And even more importantly, we are facing a very, very big explosion of our deficits as a share of GDP, simply because of our changing population structure and our commitments to pay old age pensions and healthcare spending. So, just to add all this together, how big are the fiscal gaps? These are calculations done through 2050, where I'm aiming for a terminal debt to GDP ratio equal to the current one for that country, and I'll discuss the effect of that assumption, using projections from the IMF, and assuming a real interest rate of 3% and a real growth rate of the economy of 2%. These are the fiscal gaps, baseline. Why is the US so big? The US spends a lot on healthcare. We spend over 18% of GDP on healthcare. Our public portion is only about half of that, but it's growing very rapidly. And because our public healthcare spending is concentrated almost exclusively on the elderly, because we don't have universal health coverage the way most other countries do, the growth rate of that program is going to be even higher than the growth rate of public healthcare spending in other countries, where it's not just on the elderly population. We're also running bigger deficits than other countries. But it's positive everywhere. Even a country like Germany, with a much more favorable debt to GDP ratio and what we think of as very responsible fiscal policy. If you took the debt that we've already accumulated out of this picture, it doesn't really change things that much, because just keeping the debt where it is isn't that expensive. Servicing national debt is not the problem. It's sort of the current and future deficits that we're worried about. On the other hand, if you said, well, let's suppose that we got rid of the demographic problem, that increases in government spending projected for the future coming from the growth of old age pension spending and medical care spending as a share of GDP, suppose that just stayed where it was instead of rising. Well, you could see that would make a big difference. Make a big difference everywhere. Makes a huge difference for the United States, because it makes the problem go away completely for Germany. So if that weren't there, Germany would be in surplus. The problem would be more than solved. On the other hand, if you said, well, let's suppose instead of getting down to keeping the current debt to GDP ratio constant, we actually wanted to get down to a more sustainable level in the very long term, that makes the task a lot harder for countries like Japan that already have and Italy that already have a very high debt to GDP ratio, because reducing that to 60% in itself is going to be very difficult. So all this says that countries vary in the extent to which they face fiscal gaps and therefore are under fiscal pressure, but it's a common phenomenon. That is, it's not something that, it's not just Greece, it's not just Italy, it's countries throughout the world. And the countries that we tend to think of as being in really bad shape, some people think Italy, for example, are not necessarily in this picture. Italy, for example, has had pension reforms over the last decade, which have made their longer run problem not as serious as some of the other countries. And that's something we don't typically think about when we're talking about fiscal balance. Okay, so those are the two problems. What are we going to do about it? Well, a logical solution is to have, to try to make the fiscal system more progressive and at the same time bring greater balance by cutting spending, increasing taxes, and doing both of those in a progressive manner. And a lot of the focus of that, doing so, has been on capital income taxation, wealth taxation, because we tend to think of the inequality as being very heavily associated with wealth and capital income, and so that would seem like the place to look first. But here there's another challenge that stands in the way. And here's a representation of that challenge. This is what's happened to the headline or statutory corporate tax rates in the G7 countries since 1990. And here the United States is an outlier, but in somewhat different. This is through 2017, so this is prior to the most recent tax legislation in the US, which happened at the end of December and comes into effect this year. The US basically nothing happening there, but everywhere else, declining corporate tax rates. The one that you might say is the least evident is France, the light blue line, but France is in the process right now of lowering its corporate tax rate. So if one extended that beyond 2017, you'd see declines in France as well. What's going on? Why has this decline in corporate taxes happened? It's happened because there's been an increasing mobility of capital, increasing competition among countries for business activities and for capital. And this competition, one of the symptoms of this competition has been countries cutting their tax rates to try to preserve their tax base. And it's not simply competing for the capital itself, not simply trying to get companies to invest in their countries, but also trying to keep companies from shifting profits. That is, companies that may be operating in the US or Canada, reporting their profits in the Republic of Ireland or Luxembourg or the Cayman Islands or Bermuda or one of those pleasant places with very low tax rates. So there have been a variety of responses or potential responses suggested to dealing with this tax competition. That is, if we want to raise taxes and we're confronting a situation where tax rates are going down, it seems like we need to do something to arrest that. Well, there have been some initiatives to do that. The US has introduced various legislation to try to reduce tax evasion by high wealth individuals. There have been initiatives in particular from international organizations, in particular the OECD. The BEPS is an acronym for Base Erosion and Profit Shifting, trying to encourage countries to engage in cooperative activities to try to keep companies, wealthy individuals, but especially companies, from shifting their profits from one country to another. I'm skeptical, and I'm not alone in my skepticism, about the likely success of these kinds of approaches. The basic problem is these tend to be, you might say, trying to treat the symptoms rather than trying to treat the causes of the underlying problems. That is, you've got companies that are increasingly mobile, that can report profits very easily in countries where they don't necessarily earn them because of the complexity of their business arrangements, operating around the world, using a lot of intangible assets and intellectual property to produce, where it's not easy to say where those assets actually are, and trying to just sort of throw sand in the gears of the process sometimes stops some activities but encourages others. For example, some of the rules that the US has adopted in recent years trying to tighten what companies can do has led to what we so-called inversions, where companies just simply said, well, if that's the way you're going to be, then we'll just stop being a US companies. For example, the recent merger between Tim Hortons and Burger King. Burger King no longer, that combined entity is not a US company. Burger King is no longer a US company. That combined entity is a Canadian company because Canada has laxer rules regarding these things than the United States does. Its basic problem is that we're trying to fight a war that we really don't have any hope of winning, which is trying to tax companies based on where they're earning income in a world where income is earned is very difficult to say. The rise of the multinational corporation, the more intense use of intellectual property as a fundamental component of production means that we don't know where the income is being earned. And so if we try to put restrictions on companies in terms of where they can report the income, they'll figure out some way to get around it. And it won't necessarily end up benefiting us in the way we hope it will. So one might want to think about more fundamental alternatives. That is, rather than trying to preserve the existing system, which has led to corporate tax rates going down because of capital mobility and difficulty of measuring where income is being earned, what can we do? Well, there's one popular fundamental approach, not one to which I subscribe, which is to try to introduce some sort of tax on global wealth. This was most famously put forward in Thomas Piketty's book, Capital in the 21st Century, talking about the fact that wealth inequality is very severe and that taxing wealth is a way of dealing with that. In some respects, it's better than trying to get it through from companies, because individuals may not be quite as mobile around the world as the companies in which they own assets. But still, measuring wealth is difficult, and tracking it, knowing where it's being held. And in addition, we might worry about the economic effects of very high wealth taxes, because we do know from research that high taxes on wealth and capital income do discourage saving and investment. And so the trick here is to try to get money from those who can afford to pay without having, first of all, in a way that's feasible, but also in a way that doesn't cause a lot of economic damage. So this has led many, myself included, for many years not being such a fan, to think more about consumption-based taxation. It's attractive from an enforcement perspective because it's easier to track consumption expenditures than, say, capital income or wealth. It doesn't discourage saving because you're taxing consumption rather than taxing saving or the income from saving. And indeed, you might say the proof is in what's happened. Just as corporate tax rates have been going down, VAT rates have been going up. So here are the G7 VAT rates. Just in case you don't think I made a mistake in only putting 6 series on this graph, the US doesn't have a VAT. And so we're there, but we're just sort of tracking the horizontal axis. But all the other countries have VATs, and as some call it GSTs. And as you know, Canada adopted one in the early 90s. Japan adopted one in the 1980s. Other countries had them earlier. The European countries had them earlier, going back a few decades. But even in the countries that had them, they've been going up. So countries, as they've been cutting corporate taxes, one of the ways that they've been making up for it is by raising consumption tax rates, because consumption taxes do work pretty well. Now, the problem, of course, with that is that may be a solution for dealing with fiscal imbalance, fiscal pressure. It doesn't really do anything to help us with the problem of inequality. Some people think, on the contrary, that VATs are regressive. But consumption-based taxation can be progressive. The fact that we often think about consumption taxes as not being so is just because we tend to think about VATs. But there are various ways of imposing taxes on consumption, even including transmissions of wealth from one generation to another as an act of consumption, that can make these taxes quite progressive. One can also take this approach at the level of business taxation. That is, rather than simply having a consumption tax like a VAT, you can use the same basic structure, including basing the tax on where goods and services are sold rather than on where they're produced, but just do it for a business level tax. That's something that, as Robin mentioned, I've been working on in recent years. Starting my work, well, it goes back before this, but one paper was a paper in the Murley's Review with Mike Devereux and Helen Simpson. That's the first 2010 paper. Basically a destination-based corporate tax, known sometimes by the acronym the DBCFT, destination-based cash flow tax, which is not only a tax on consumption, but it's progressive tax on consumption because, unlike a VAT, it provides relief for the labor part of value added. So it's really just a tax on capital. But it's taxed on consumption from capital, and therefore has administrative properties, enforcement properties that are much better than attempting to tax wealth. But like a consumption tax, encourages domestic investment. This actually, for a time, was something that was playing in the United States. So I couldn't make this any bigger or more readable, but basically what this says, this is from a document that was issued by the Republican majority in the Ways and Means Committee, the Tax Writing Committee in the House of Representatives in June of 2016. Which says, I'll just read, it says, this blueprint eliminates the existing self-imposed export penalty and import subsidy by moving to a destination-based tax system. Under a destination-based approach, tax jurisdiction follows the location of consumption rather than the location of production. This blueprint achieves that by providing border adjustments. That's what value-added taxes have, exempting exports and taxing imports, exactly the way value-added taxes do. And the key thing for political purposes in the US was this was working within an existing tax system, because enacting a VAT in the US is for a variety of historical reasons that are really special to the US. It's been very difficult to do that. This was for about a little over a year, this was a very live option in the US as we moved into our tax reform. It was issued in June before the presidential election. In some sense, it was a bit of an aspirational document because it was issued by a party that thought it was, after the election, that it was still going to control Congress, but was not going to control the presidency. And so it was, if you like, it was their initial opening bid in a discussion of tax reform, and this was stating their position. It turned out to be much more than that after the election, when the party controlling the presidency was the same as the party that wrote this document. And so there was a flurry of activity in the spring talking about this proposal. And in the end, it didn't make it. This was a document issued at the end of July. And it didn't make it simply, I mean, one can get into more detail, but it represented a really big change in the way we do things in the United States. And there were, in the end, the Republicans were trying to do tax reform with a razor-thin majority in the Senate, which meant that they had to have pretty much every Republican senator voting for the proposal. And there was enough dissent, this being a very new idea, that some of them, I think mistakenly, felt would hurt some of their constituents, that they didn't do it. And so we ended up instead with a big tax cut for corporations. So we joined the party. In the graph I showed you earlier of declining corporate tax rates, we're now not at the bottom, we're at 21%. We're still above the UK, for example. But we've definitely moved in that direction. And we've moved in that direction in other respects. There was a bit of a legacy of this approach in that some of the measures that we adopted in trying to make our corporate tax work better actually do involve the destination-based approach of increasing tax on exports, increasing tax on imports, reducing tax on exports. Possibly in a way that will prove to be in violation of World Trade Organization rules, but as you no doubt have realized at this point, violating international trade agreements and norms is not something at the top of the mind of the US government right now. So we went ahead with this, and we're likely to go ahead with other measures, which unfortunately are probably more destructive to world trading environment than a destination-based cash flow tax would have been. So where do we go from here? And I'm thinking here not just the United States, but the world. Well, we've got a lot of work to do in terms of dealing both with inequality and dealing with fiscal pressure. Dealing with inequality, it would be nice to think that there are simple government solutions for dealing with inequality. Governments, the US, I gave you figures for, it's true of other governments as well, engage in progressive fiscal policy which lessens the degree of inequality in different societies. And there are ways of doing that, but I think in our modern 21st century economy, those ways don't include some of the approaches that many people put forward. And I think in order to have progressive tax systems that work in the 21st century, we're going to need things that move more in the direction of consumption-based taxes, not just through VAT increases, but through something like destination-based cash flow taxation. In addition, countries have serious fiscal challenges that those tax measures alone won't probably be enough for. And that involves reform of public expenditure programs, which will be enormously difficult politically. It's something that most countries just find it very difficult to deal with, and that's one of the reasons why most countries haven't dealt with it yet. But that doesn't mean they won't, because the numbers don't lie. And as pressure increases in the future, we undoubtedly will be dealing with that. It's hard to know where this is going to come from first. It's hard to believe that the US right now is going to be the leader in this area, although things change rapidly over time. And so the next few years are likely to be a very interesting time in terms of innovations in fiscal policy, and it certainly needs to be given the problems that we face. Thank you.
Okay, thank you, Alan. Well, we have some time for questions, so, John.
I know very little about taxation, but I think in Canada, when the Ottawa government has problems with deficits, they shift them to the provincial governments. I think in the United States, the states governments are not allowed to run deficits. So some of your charts that made Canada look so great, was that because it was just the Ottawa government, or?
No, that's general government. That includes all levels. Now, whether the IMF is doing it right, I can't tell you, but and it's true. The U.S. that solution approach works. The U.S. uses too, and indeed we use it at lower levels of government. In California, we in recent years have been shifting responsibilities from state onto local governments. Yeah.
With the recent U.S. tax reform, do you think that Canada will have to respond with tax changes of their own?
Well, it's certainly true that the U.S. Has put pressure on countries that have, the U.S. was relatively high in terms of its tax rate, and that was actually helping Canada. I mentioned the Tim Hortons Burger King merger, but there were other things like that. I think it's putting pressure on not just Canada, but other countries as well. That is, there have been several rounds of tax competition as different countries cut their tax rates. And I don't think the one we've adopted is necessarily stable. The UK is, one of the UK responses to Brexit was to propose, as a way of maintaining business activity, even with some of the negative incentives associated with Brexit, was to propose cutting the corporate tax rate even more in the UK. We could see further rounds of corporate tax cuts. Canada could be under pressure to cut its corporate tax rate as well. I mean, if I were Canada right now, I think I'd be worrying more about trade policy. But those two things are both issues.
So one interesting difference between Canada and the US in cutting corporate taxes is when Canada cut the corporate tax, the dividend tax credit was reduced, implicitly raising individual taxes on income that flowed through corporations. I don't believe the US has done that, have they?
No, we actually lowered dividend tax rates in 2003 during that period when nothing was happening at the corporate level. Those are still lower, and we didn't do it in the most recent reform. We lowered individual tax rates on regular income a little bit. We didn't do anything to the dividend tax, and so the low corporate tax rate just flows through. That's right. One of the interesting things about the U.S. tax reform was that one of the ways that they made it work was by not trying to be fiscally responsible. That is, if we think of a fiscal tax change as we in the U.S. had in 1986, where you say, well, it has to be revenue neutral overall, which means if somebody's taxes go down, somebody else's have to go up. That naturally creates winners and losers. If you're trying to satisfy everybody, or at least everybody in the Republican coalition, and of course they come from heterogeneous states and so forth, it's really hard to make them all happy unless you give everybody, it's not everybody, but a large fraction of the population tax cuts. Now, that means that the overall revenue goes down. It's actually worse than that because there are a variety of temporary provisions in the legislation which mask how much the annual revenue loss actually is. And so, again, in thinking about the future, the US will have to have some sort of additional tax legislation in the near future, even if there are no changes in our philosophy of taxation, simply because we have to deal with all these temporary provisions.
In his book, Affluence and Influence, Martin Gilens, a political scientist at Princeton University, concludes that the preferences of the vast majority of Americans have absolutely no impact on the formulation of government policy. How long can the U.S. continue in that sort of situation, or how can you effect change when that is indeed the way the government system works?
I guess I'm a little skeptical about that conclusion because I think it presumes that people's preferences are stable and that they know what they are. I think a lot has been made about people voting against their own interests or what appear to be their preferences. So you might say that what is in the interest of most people is inconsistent with what the government is doing, and I don't disagree with that. I think knowing what the people want is a little bit more difficult. It's certainly true that we have, as a result of the First Amendment and other things, we have a very, very strong influence of money in politics, and that certainly affects outcomes. And we also, because of the fact that our voting system, our electoral college is, and our Senate allocation of seats are very distinct from being based on population, we are more or less stuck with certain anomalies. I mean, for example, it will always be the case that the United States tilts more toward the interests of less populated states because our Senate has the Vermont has the same number of senators as California. And so if you think, well, about the interests of urban versus rural areas, well, it's pretty clear that rural areas are going to be overweighted. If you think about the Electoral College and the outcome in 2016, again, the outcome in the Electoral College was quite different. I live in a state where Hillary Clinton won by over 4 million votes. And that counts, there are a lot of wasted votes in those states. This isn't going to change. Those kinds of things will never change because they would require a U.S. constitutional amendment. And a U.S. constitutional amendment has to be approved by a supermajority of states. And obviously that's not going to happen because it's not in the interests of a majority of states. Same thing with First Amendment is a little bit less clear because that's subject to Supreme Court interpretation. But at least for many years now, the Supreme Court has been increasingly moving in the direction of allowing pretty much anything in terms of expenditures of money and so forth to qualify as protected under the First Amendment. We've gone from a period in 2008 when we elected a president where many people were surprised at how far the U.S. had come, that it was able to elect an African-American president, and people were surprised also at our outcome in 2016. So I think, if one takes a longer view, things can change a lot in the U.S. even with the constraints we face because of our Constitution. That's not necessarily saying they're going to get better, but they may be different.
I was at a tax policy conference a few weeks ago where a number of the speakers spoke pretty highly of the BEPS, the base erosion that strategy, and some of them actually advocated for a more wide-reaching something analogous to the IMF, but for international corporate taxation or writing that in and codifying it into trade agreements. Could you just highlight some of your opposition?
Sure. First of all, as I said, but I'll just expand on, I don't think it has any the approach is not founded in any kind of basic economic reality. For example, saying that companies, in order to declare profits in the Republic of Ireland, have to show that they have key personnel or certain levels of economic activity in Ireland. Well, one possible outcome of that is that companies from Silicon Valley will move some of their operations to Ireland. It doesn't seem like something that the US would find in its interest. Second, unlike trade, where I view trade agreements as basically countries agreeing among themselves to undertake policies which are in their own mutual interests, but which domestic interest groups may fight against. So we might say in the US, low tariff barriers are good for the US as a whole, but the steel industry or the aluminum producers are a strong lobby. And so without international agreements, it will be harder for, leaving aside the failure right now, but it'll be harder for US government leaders to withstand pressures from such interest groups. And so free trade agreements serve to strengthen the ability of governments to do what's actually in the interest of their own citizens. Contrast that with tax agreements like what the BEPS is trying to do, which is to make some countries better off at the expense of other countries. Imagine you're a country in Eastern Europe where you have very little capital because of the history of Eastern Europe. You're trying to develop rapidly. You're trying to attract investment. You want to have low taxes. You want to have very generous rules regarding what multinational companies can do. And along comes an international organization that says, you know, we really think we need to harmonize corporate taxes. And we think everybody should have a pretty high corporate tax. Well, that's not in your interest. And it's not as though your domestic government is trying to withstand sort of narrow interest groups that want to help themselves at the expense of the country. It's more the case that you have a national interest to do things that are at odds with what other countries want you to do. And I'm not talking here about tax havens that are, simply, siphoning profits from other countries and not really doing anything. These could be real national interests that countries have. And because of the great heterogeneity in national interests, I think it's really hard. Now, you could say, well, if France and Germany, which want to have higher corporate taxes and bigger government sectors, make large transfer payments to Poland, then they could have a harmonized system. That's true, but I think that effectively is not going to happen. And I think the difference, and the reason why I've pushed destination-based taxation as an alternative, is because that is something that can happen with individual countries. It's in the interest of countries to do that. They don't need international agreements to do it. It'll be in their interest to do it even without international agreements. And the problem with international agreements with respect to taxation is that you have to have countries agree to do something that's not in their own national interest. And I think that's very hard to enforce.
Because there is a kind of phenomenon that there is trillionaires and billionaires from a lot of countries around the world trying to escape the tax and deposit a large amount of their wealth in the private banking in Switzerland.
Yeah.
How do you think about the
Right.
existence of this kind of industry of private banking
Yeah.
to the effect, possibly either positive or negative to the tax policy implemented around the world?
Well, I think the whole problem with private banking and the Panama Papers and all this is Switzerland and Luxembourg. I think this is one of the problems of trying to implement reasonably high levels of individual wealth taxation. We can put pressure on secret countries that allow bank secrecy and don't let information out about tax evasion, which is really what we're talking about here. We're not talking about behavioral responses to lessen tax liabilities. We're just talking about pure tax evasion. But I think ultimately the nature of the taxes we're trying to impose there makes it difficult. And I think, I'm not saying we should give up on trying to enforce national taxes. I'm just saying that the costs of doing so, in light of the fact that, again, there are going to be countries that have an interest in not participating and in helping people hide their assets, I think it's difficult.
It was clear in your presentation that the current U.S. tax policy has a positive effect on inequality in the lower quintiles.
That's, by the way, that's tax and transfer policy, but yes.
Okay.
Yep.
Mm-hmm. And then you moved on to how the fiscal stress can be alleviated with the location-based consumption tax. I'm curious, would that kind of tax have a helpful effect on inequality as well?
Yes, it would, because it's basically a tax. It's basically a tax on wealth, not only wealth in its current form, but basically any future rights to wealth earned by less than competitive behavior, earning higher than normal rates of return, anything that individuals as holders of wealth, owners of businesses, and so forth, any income they can generate in the future that isn't simply earning a normal rate of return on investments, on new investments, or coming from wage and salary income would be taxed under that tax. So it's a progressive version of a consumption tax.
Maybe I can ask a question about that. I'm a big fan of this destination-based corporate tax, but not as an element in itself, because it's got a relatively narrow base. And in the context of your discussion where there were these two problems, inequality and fiscal sustainability, it does something for inequality, but it doesn't do a whole lot for fiscal sustainability. And so the question is, why don't you go all the way and advocate a VAT, which is essentially the same as a destination-based corporate tax plus a tax on labor?
Well, I think if the U.S. were going to be serious about dealing with inequality and fiscal balance, we would do both. We would have a broad base. I mean, one of the problems with VAT is that, and I'm not sure how broad the Canadian VAT is, but I know the European VATs are narrower than they ought to be good taxes. New Zealand is famous for having a pretty broad VAT, but there are a lot of goods and services that are excluded. We have even bigger problem. We have sales taxes retail sales taxes at our state level, which are much smaller than the national VATs, but they're also very narrow bases. They leave a lot of things out. So adopting a VAT with a broad base, combining it with a destination-based cash flow tax, and having some sort of progressive reforms of our entitlement systems would be, if I were dictator, the package that I would advocate for the U.S.
So it seems to me like a lot of the problems that are going to arise in terms of fiscal gaps and that are growing deficits are basically the result of this demographic catch-up, right, where the demographic pyramid is being inverted, so to speak. So eventually there will be a catch-up, right, and presumably if life expectancies don't continue to grow, we'll reach a new equilibrium. Why, in your opinion, should we act now to address the fiscal gaps and the deficits and not wait for the new equilibrium?
Okay, there's two parts to the answer to that. The first part is that we're never going to get there because life expectancy, even though it's growing differentially, is still growing. And so population aging will continue. If one looks at the US, and it's probably true in Canada too, there is a baby boom bulge in birth rates after high birth rates after World War II. And so it is happening more rapidly now as that generation, of which I am a part, is getting into retirement age. And so it's happening more rapidly now, but it's going to continue happening because life expectancy is going to continue rising. And whether, maybe not as quickly, but it will be happening. The second part is, even if the story you started with, that is, it's life, the old age dependency ratio is going to rise and then it's going to stop rising. We would want to start dealing with it now because the burden, there are two things. First of all, we want the burden of this adjustment to fall on as many generations as possible. And the longer we wait, practically speaking, you can't go to an 80-year-old and say, we're cutting your benefits in half. And so, for example, a few years ago, there were some congressional proposals in the US, which went nowhere, but the structure of the proposal was that that generations 55 and older would be held harmless. And the idea was, if you're in or near retirement, we're leaving you alone. Well, each year that we wait, another age cohort goes away in terms of our ability to spread the burden. So that is one reason. The second reason is that even if we are not undertaking policies in terms of making changes today, announcing changes today for the future is beneficial because it gives people time to plan. So for example, if we are going to reduce pension benefits for people who are currently 40 years old, it's better for them to know now that their pension benefits are going to be lower so that they can make work decisions until when to retire, how much to try to earn while working, how much to save. All these decisions can be made more effectively if people have some idea what the future is going to look like.
Okay, well, maybe it's time to call it an end. Thank you very much for that nice talk. It was very understandable and at the same time very convincing, I would say. And if you want to hear more about what Alan has to say, he's giving a department seminar tomorrow at 4 o'clock, to which you're all invited. And if you want to have a chance to talk to him individually, the Department of Economics is hosting a reception at the University Club starting at 5:30. Thank you.